6 dividend stocks at their 52-week record low. Are you in the market for reliable dividend stocks? Well, you've come to the right place because in this video, we're unveiling 6 companies with a history of consistent payouts, all currently trading at their 52-week low. Let's see if these bargains can be the income-generating powerhouses your portfolio needs. It is often said in finance that one should buy low and sell high. But where exactly is low? Today, we're cracking the code on 6 specific dividend stocks that have dipped to their lowest price in 52 weeks. Could this be the fire sale you've been waiting for? Let's investigate. Number 1. Johnson & Johnson. Let's kick things off with a household name, Johnson & Johnson, or J&J as it's known on the stock market. They're a healthcare giant with a finger in almost every pie. Pharmaceuticals, medical devices, and even consumer health staples like Band-Aids. Now, if you've been watching the market lately, you might have noticed J&J stock has dipped to a 52-week low. But hold on. Before you panic, some investors see this as a buying opportunity. Here's why. Analysts are generally positive on J&J. While some recommend holding, many have it as a buy. Plus, they boast a healthy dividend yield of over 3.3%, which has grown steadily at over 6% for the past 10 years. Think of it like this. If you invested $10,000 in J&J today, projections show it could potentially grow to over $45,000 in 30 years, with additional dividend payouts of over $15,000 on top of that. J&J is known for managing risk and staying stable during market ups and downs. They also invest heavily in research and development, constantly innovating to stay ahead of the curve. Plus, their global reach and efficient supply chain are major advantages. With the ever-growing demand for healthcare, J&J's leadership and focus on innovation position them well for future growth and profitability. So, while the recent dip might seem scary, it could be a chance to snag a piece of this healthcare powerhouse at a discounted price. Number 2. Nike. Next up, we have a legend, Nike or NKE. This swoosh logo isn't just a symbol, it's a global leader in athletic wear. From top athletes to everyday gym goers, Nike equips people to push their limits. Now, here's the interesting part. Nike stock has dipped to a 52-week low recently. But before you write it off, hear me out. Despite the drop, Nike is financially strong and poised for future growth. Sure, some analysts are cautious, but many still recommend it as a buy. Plus, they offer a decent dividend yield of over 1.5%, which has grown an impressive 12% on average over the past decade. Here's a fun thought experiment. Imagine investing $10,000 in Nike today. Projections suggest it could potentially balloon to almost $30,000 in just 10 years, with additional dividend income on top of that. Long term, we're talking potential for hundreds of thousands in returns. Here's what makes Nike a compelling opportunity. Brand power. Everyone knows the swoosh. This brand loyalty translates to consistent sales. Global reach. Nike sells its products worldwide, giving them a massive customer base. Innovation engine. Nike constantly develops new technologies and trendy designs, keeping them ahead of the curve. Direct-to-consumer focus. By selling directly to consumers, they increase profits and build stronger relationships. The athletic wear market is booming, and Nike is a clear leader. While the recent dip might seem concerning, it could be a chance to grab a piece of this iconic brand at a discount. Number 3. Accenture. Our third pick is Accenture, or ACN, a powerhouse in the world of professional services and outsourcing. They're all about helping businesses innovate and navigate the ever-changing tech landscape. Now, you might have noticed their stock has dipped recently. But hold your horses. This could be a golden opportunity. Sure, the stock is down to a 52-week low. But here's the good news. Analysts are still bullish on ACN. They see it as a long-term winner, with many recommending it as a buy. Plus, they offer a solid dividend yield of over 1.8%, which has grown a healthy 11% on average over the past decade. An investment of $10,000 in ACN today could potentially quadruple in value over 10 years, with additional dividend income on top of that. Long-term, we're talking potential for hundreds of thousands in returns. Here's why ACN is so attractive. Digital transformation experts. Businesses are rushing to go digital, and Accenture is at the forefront, helping them with everything from cloud computing to security. Cutting-edge technology. They constantly invest in new technologies, keeping them ahead of the competition. Global reach. ASEAN serves clients worldwide, giving them a massive market and diverse revenue streams. Strong client relationships. They build long-lasting partnerships, ensuring repeat business and growth. The digital revolution is unstoppable, and Accenture is perfectly positioned to capitalize on it. Number 4, AbbVie. Next up, we have AbbVie, or ABBV, a major player in the healthcare game. They're big in areas like immunology, oncology, and virology. Basically, they develop treatments for some of the world's toughest diseases. You might even recognize their famous drug, Humira. Now, their stock price has dipped recently, but don't hit the eject button just yet. Here's why ABBV could be a smart long-term investment. Analyst confidence. Despite the dip, analysts are still positive on ABBV. Many recommend it as a buy. Dividend machine. ABBV boasts a juicy dividend yield of over 3.8%, which has grown a staggering 14% on average over the past decade. They reward their investors handsomely. Growth potential. Historically, the company's share price has appreciated by over 11% annually. Imagine someone invests $10,000 in ABBV today. Projections suggest it could potentially grow to over $43,000 in 10 years, with a steady stream of dividend income on top of that. Long term, we're talking potential for hundreds of thousands in returns. Here's what makes ABBV so attractive. Strong product portfolio. They have a wide range of successful drugs, generating consistent revenue. Innovation pipeline. ABBV constantly develops new medications, ensuring future growth. Strategic acquisitions. Smart purchases like Allergan have bolstered their market position. Focus on R&D. They invest heavily in research, staying ahead of the curve in healthcare advancements. Number 5. NetEase. Let's head to China with NetEase, or NTES. This tech powerhouse is a leader in online services like gaming, e-commerce, and internet content. If you're a gamer, you've probably encountered some of their popular titles. Now, their stock has dipped recently. But hold on a minute. Analysts are still bullish on NTES, with many recommending it as a strong buy. Here's why it could be a great investment for the future. Riding the digital wave. NetEase is perfectly positioned for growth in online entertainment and e-commerce, two booming sectors. Tech savvy. They invest heavily in cutting-edge technologies, keeping them ahead of the competition. Strategic partnerships. Smart collaborations expand their reach and user base. Strong brand and loyal users. A well-known name with a massive following translates to consistent revenue. And let's not forget the dividends. NetEase offers a healthy yield of over 2.2%, which has grown to an impressive 24.7% on average over the past decade. They reward their investors, while their share price has historically appreciated by over 20% annually. If you invest $10,000 in NTES today, projections suggest it could potentially grow to almost $80,000 in 10 years, with a stream of dividend income adding to that. Long term, we're talking potential for millions in returns. While the recent stock dip might seem like a reason to hesitate, it could be your chance to snag a piece of this future leader at a discount. Number 6. Ulta Beauty. Last but not least, we have Ulta Beauty, or ULTA, a major player in the cosmetics and beauty retail world. While they don't currently offer a dividend, analysts on Wall Street are bullish, recommending it as a buy. Now the stock has dipped recently, but don't let that scare you. Here's why Ulta Beauty could be a good long-term investment. Impressive growth. Ulta Beauty's sales have nearly quadrupled over the past decade. They've consistently delivered double-digit sales growth year after year. Strong financials. They boast healthy free cash flow, meaning they generate a lot of cash from their operations. They're also good at managing debt and keeping it under control. Share buybacks. Ulta Beauty has been buying back its own shares, which can boost the stock price for remaining shareholders. Profitability on the rise. Their profit margins have been increasing steadily over the past few years. Future potential. The beauty industry is expected to keep growing, and Ulta Beauty is well positioned to capitalize on that. Here's the caveat. Ulta Beauty doesn't currently offer a dividend. However, with their strong financials and growth prospects, they might consider initiating one in the future. This concludes our list of 6 dividend stocks trading at 52-week lows. Remember, this is for informational purposes only. Conduct your own research before investing. And as always, thanks for watching and subscribe for more.